Hello and welcome as Mike Sloan, Chief Marketing Officer of Wright Flood, discusses the new product, Private Flood Alternative.
Thank you, everyone. Private Flood Alternative is an affordable program that provides coverage equal to or greater than that provided under the NFIP. We spent a lot of time putting this program together, probably now close to 2 years, as we saw the changes coming through with bigger waters. The carriers that we have involved are Western World, which is a A9 rated AM Best carrier, and 3 Lloyd's syndicates, ACE, Hiscox, and Channel. This program, again, is designed to provide your consumer with an alternative to the NFIP product with rates 15 to 40% less and coverage equal to or greater than that provided under the current NFIP program. The Private Flood Alternative basically follows the same NFIP rules. The coverages match or exceed the NFIP. The claims process is handled by Wright. So for your customers and for yourself, nothing really changes other than what's on that piece of paper when the policy is issued. It's a single sign-on, meaning you don't have to go anywhere else. You don't have to gravitate to another website. You don't have to start one place and go another. You start and you finish on the Wright Flood system, just like you do now. We have the availability of not only on the online rating tools, but an automated renewal process, which we're going to discuss a little later. And the regional sales managers that you've counted on for so long provide the professional expertise for you on the NFIP side are the same regional sales managers that support you with the private flood. And when we do our comparison, it's much like a comparative rater in the sense that we will list out and show you what the NFIP coverages are and the premiums for each, including the deductible, as well as what it is with the private market and who that source is to be underwriting that product. There's no hidden gotchas, and I'll talk a little bit about hidden gotchas a little later, but when we show you a price and we show you a premium charge, that's what your customer will pay. There's no additional fees, taxes, or anything else that will be added to that. And as I said earlier, the same general agency you contract with the NFIP, Wright National Flood Insurance Services, is the same agency you'll have to contract on a separate producer agreement because this is surplus lines. It's not the NFIP program, so we have to have a separate producer agreement, and it is written on an excess and surplus lines basis. And most importantly, there's no outsourcing. Again, you're not providing information that's going outside the transom and going to some other website or some other server or some other vendor. It's all retained within Wright National Flood Insurance Services. This is some of the exciting part of it. Remember I told you that it meets or exceeds. Well, here let's talk a little about exceeding what's provided under a normal NFIP policy. For those of you who've ever been in an insured loss, whether it's a property loss or for example, myself in a hurricane and Hurricane Andrew, we lost everything we had, I can't imagine what it'd be like if I had to reach in and had spent my contents dollars to support myself, my wife, and my 3 little kids. Well, and when it floods, guess what? That's exactly what has to happen. The customer either has to reach in their pocket, go borrow money, right? Or if they had a contents portion of their flood policy, they could take the contents money and use that to support themselves while they're trying to get back into their house. With Western World's program, for example, on a primary residence, they'll have $5,000 of additional living expense. So they don't have to reach in their pocket. They don't have to take their contents money. They don't have to borrow from somebody. They don't have to get a grant. They'll have the availability of that. All right? If it's a secondary residence or it's a rental property, right? And now that property is damaged in a flood, what have they lost? Well, they lost their rental income. So there's $5,000 worth of loss of rents available under the Western World program. That endorsement is $25, whether it's on the primary residence or the secondary. But both on the primary and secondary residences, unlike the NFIP, it's replacement cost. Now, how many of you out there have customers that you sell insurance to that have rental properties, vacation homes, secondaries, whatever? Now, you sell them an NFIP policy. The great news is they get to pay more for less. What do I mean by that? Well, they have to pay a surcharge, right? And when it comes to time of loss, they don't get replacement cost. They get ACV. Surprise, surprise. Well, with the Western World program on those secondary and rental properties, et cetera, they get replacement cost. So that error in admission is eliminated for you. You don't have to worry about that. Waiting periods, it can be as little as 0 days as opposed to 30 days with the NFIP. Example. Again, we're using Western World. You have a cash closing. Right now with the NFIP, if I go in and I buy a house for cash, close with cash, which, by the way, 33% of single-family homes, 60% of condominiums were cash closings. And that customer decided, and you sold them a flood policy, guess what they have to do with the NFIP? They have to wait 30 days. Now, if they have a mortgage, it's coverage right away. But if they could pay cash, they got to wait 30 days. So the chances are they're probably going to say, you know what, let me think about it. I'll get back to you. And now you've lost a sale. Well, with the Western World program, that eliminates that. For that cash closing, they can have coverage effective just like they would if they had a mortgage with the NFIP. Otherwise, it's 10 days. It automatically, the new businesses, as we were saying earlier, as you go through that process and you're starting your quote with the Wright flood system, it's right there online with you. So as soon as you choose the deductible and the coverage, if it's eligible, it's going out there, it's on a comparative rater basis, it's looking for the various markets available, and it's going to find the one that fits best and provides best coverage, and it's going to provide that to you. If it doesn't, that means that it doesn't fit any of the available markets in that particular state, and the NFIP is the best deal for that consumer. A pop-up box, if you've already sold the excess flood, you remember that little blue pop-up box that kind of gravitates up to the left-hand side of the quote screen? We'll show it just a second here. That will pop up and identify that this particular risk qualifies for the private flood. That's what the blue box looks like. So you're in there, you've now hit the coverage and the deductible you selected, up gravitates this blue box, and it says click here to quote this private flood product, that this product is available, and it gives you an indication of that price. You'll click on that box, and the next screen will say, okay, here. It shows the premium and the fees, for the private, as well as the NFIP, and the savings for each. So in this particular risk, $250,000, $100,000 contents with a $1,250 deductible for both contents and building, the NFIP says $655. And that same policy provides actual cash value at time of loss. Well, this is a Western World quote, and the premium on this is $399.71 is the price. $255.29 is the savings for that consumer. And what do they get with that? Not only do they get the $255 savings, they also get loss of rents, and they also get replacement cost, 2 enhanced coverages. When you look at the Western World quote, again, it's going to give you the NFIP. It shows you the premiums and the fees. It shows the private with the premiums and fees and the savings. Many times, agents, as we've rolled this out across the country as part of their best practices now, they will screenshot this page. So let's say the customer says, no, I don't want it. Okay, fine. They'll screenshot the page, and they may have had the customer initial it, scan it, put it into the file. The customer took the NFIP policy. They come back later on. There's a claim. They go, what do you mean I don't get replacement costs? I thought I could have had replacement costs. Well, you could have. In fact, you could have had that, and you could have saved $255, but you elected to buy the NFIP policy, and you see right here. We showed it to you, you signed it, and decided to go elsewhere. So there is no hidden gotchas, because as I roll this out, and as many of you I've met over the years know, I spend 45 plus weeks a year on the road, going from place to place, meeting with our agents and our regional sales managers and clients, discussing the NFIP program and now the private flood as we've rolled that out. They'll say, gosh, I had this company, I went on the internet, I found it, or my customer found it on the internet, or whatever it was, and they got a quote, and then by the time I sold them $400 or a $500 quote, and then when I went to issue the policy, they said, well, yeah, it's $500, plus there's a tax, plus there's a service fee, plus there's this, there's that, or it was merely a rate indication and it really wasn't $500, it's really $600, and I lost all credibility with my customer. Well, you don't have that problem when you use our system, because when we give you a quote and show you the savings, that's what it is. There's always formalities, right? The application's got to be signed. Well, it has to be signed here too. All these forms are on the system, so as you're going through this process, it's not as if you have to deviate and go find one out of a file or someone. It's right there on the system, so your customer and you are going to have to sign the application, because again, this is excess surplus lines. Right, and there are certain rules and requirements, one of which these things have to be signed, and it has the surplus lines disclosure at the bottom of the form that, again, reemphasizes the fact this is surplus lines. It's not subject to regulation of the state in the sense that it also is not guaranteed by the State Guarantee Association. All those things are disclosed. These are requirements provided by the regulators. Okay, so here's a diligent effort form, and I know we have people in many states on this, and it varies by state. So if you've sold any surplus lines business in your agency, you've seen these forms before. They're not brand new. All right, so you could be in a state, for example, like Texas that requires, well, actually Texas, the regulation is such that you have to make a diligent effort. There is no specific number. And when you actually read through the statutes. So it could be as little as one marketplace I searched, and it could be as many as 1 million. And it really doesn't matter. It's up to the association at the time. But for example, here where it shows 3, you would literally go through the phone book and you call, for example, your local Allstate agent, your State Farm agent, your farmer's agent, and say, okay, I want a standalone, not an endorsement to a homeowner's policy, but a standalone NFIP-like coverage at least equal to, if not greater than the NFIP, in an admitted market. Do you have one? And more than likely in most places, there's not going to be one. And in some places where there have been an admitted market that's been introduced, the risk may not qualify. So even then in that circumstance, you made a diligent effort, you've notated it, you need to scan that, upload it with the application so you have it. Also maintain a copy, which most of you do in your paperless files. So if there's ever an audit by the Stamping Association, you can provide it. If you're into doing this at all, excess and surplus lines on any product, typically that's what your managing general agents will require of you. So this is, again, just a sample of that form and questions that it may be California. This is part of California's disclosure. It requires that it be in 16-point font. I guess the thought process of Governor Brown is if I make the word bigger, it's easier to understand and know the definition of it. In jest, but literally it's 16-point fonts. It takes almost 2 pages for the surplus lines notice for the consumer, and they have to read through it and they have to sign it. Again, it's not my desire. It's the regulations, the rules, and requirements. And again, we have to have the forms in our possession before we can issue a policy. So whether that's on the renewal process or whether that's on the new application process, okay? We have to have them, otherwise we can't issue. And then we get down to the last section. Again, they would sign and date it. Again, each state has their separate forms and separate requirements. There are some states, for example, that don't require a diligent effort. New Jersey doesn't require that. Florida through October, I think, 1st of 2017 doesn't require that. You still have to sign the disclosure, but not diligent effort. So how did we get it with the pre-selection part? As we started to roll this out, and we began this process is a little over a year old now, as we've kind of test marketed and kind of grown this out. We sit down with the agents and they go, God, this is great. I really like to do this. I want to take all my renewal book and I'm going to work this thing and I'm going to send letters out and make phone calls and do all these things. But the reality is reality. And if I'm sitting there in front of you and I looked at you in the eye and said, okay, tell me how many of you have excess staff and excess time every day on your schedule. And virtually, as I've done that across the country, I haven't found an agency yet that says, you know what? At 3 o'clock, we take an espresso and latte break, and then we sit back in our office and take a nap until 5, and we go home. Everybody is working as hard as they can, stretched as thin as they can, and as much as they want to do it, they just don't have that additional time. So they looked over at us. They said, hey, Mike, is there anything you guys can do it right? You have this information. I signed the agreement and the producer agreement that says you can, we want to solicit our renewals, but it's expensive. We sat around and we said, okay, and we worked with our IT guys and our operations people and our underwriting team and said, what if we do this? Hey, you sign and we will send out a pre-selection letter to all your clients that qualify. And we'll do a solicitation up front and inform that customer that they have the opportunity. Because I guarantee you, again, if I'm sitting there in front of you and I say, okay, how many times have you heard in your career, can you shop my flood? Have you shopped my flood? I want you to shop my flood, right? And you're going, okay, I can shop it and shop it and shop it. It's the NFIP, so it's the same price as long as it's underwritten correctly, same whatever you do, wherever you go. Well, now with those customers that are eligible, will already be notified and pre-selected. So we will generate that information and required forms and send that out to your customer. And yes, they got to fill them out. Yes, they have to sign them. It's a prepaid envelope to send it back. along with the coupon and the form. So we try to make it as easy as possible. We try to basically step in front and do all that for you. It doesn't mean you're not going to get a phone call. It doesn't mean there's not going to ever be a question. But we're going to take the time that you don't have, and at our sole expense, we're going to send this out to them. And we're going to go through the process of how that works in just a minute. So again, we'll review. We go through the system. You sign the contract with Wright National Flood Services, and I know we have people in California on this phone call, I presume. So there, it's Wright Flood Insurance Services, DBA. We'll send the intro letter to your clients with the renewal offers. The diligent effort form, if it's required in that state, has to be completed, retained by the agency, and we ask again that you upload that and scan that and send that in to us as well, so we both have it. So what does the renewal offer basically say? Basically, it tells the consumer that the coverage is equal to or greater than the NFIP. So nowhere are we going to offer the customer less coverage. We're going to offer the customer equal to or greater than. The service doesn't change. If they're used to calling you BBT, baby, they're going to call you again because you're the same age. We don't surcharge for the secondary residence. Raise your hand if you've had somebody complain about getting surcharged for secondary residence. And I give lower premium than the NFIP, anywhere from 15 to 40% less. You have the same Wright people working the program with you side by side, both at our shop and out in the field with you. And the underwriting, again, is through companies that are AM Best, A-rated, financial category size 9 or greater. So here's a sample of what the letter looks like to the customer. So it informs them that their policy is going to expire on a certain date, in this case 3/15. And here's what's available for you. Coverages equal to or greater than the NFIP. Your agent's the same. It lays out the premiums. It lays out the surplus line taxes and fees and gives them the amount that they would need to pay, along with the forms and a prepaid envelope to mail it back. Again, if we don't get the forms and the payment, guess what? We can't issue the policy. So how does the process work? 75 days prior to expiration, we will send out that renewal solicitation for the consumer with the private flood. As is the case now and has been the case for years and years and years, the normal NFIP renewal goes out at 56 days. So 75 days out, they get a letter saying, hey, you're pre-qualified. By the way, here's the rate, here's the program, here's the underwriting carrier, et cetera. And they don't do anything. So 56 days out, bingo, out goes their renewal offer for the NFIP policy. They don't do anything. At 30 days, out goes a reminder notice of the private flood. They still don't do anything. 15 days out, they haven't renewed their NFIP policy, and they certainly haven't bought the PFA, the private flood alternative. So that, again, that NFIP renewal notice goes out, hey, 15 days is getting close. You need to do something. Wait, pay attention. The notice of the PFA insert, just basically reminding them that they were offered that as well. And at 0 days, we send out a notice, as we always have, saying, okay, your policy is expired. You have no coverage. And then on the private flood, 30 days after expiration, if we still haven't seen anything, we'll send out, again, a reminder that the PFA is still available, although now there's a waiting period, right? Now, the underwriting companies can vary by state. And what I mean by that is each carrier has given us the determination of what states they want to operate in. The Western world is in all 5 states that we've brought up live. And for those of you who aren't aware, the 5 states we have currently live, and we'll be bringing more states live as we continue to go through 2016, are Florida, New Jersey, California, Texas, and Louisiana. So if you're not in one of those 5 states, you don't have any risk in those 5 states, hang on, we're coming, okay, just like the song goes. We'll get there, but we'll make sure we have everything set right, and we're doing this thing very cautiously, very deliberately. And you say, of those 5 states, what does that mean? Well, if you looked at the NFIP, all the policies written in the NFIP program, and you looked at those 5 states, that's about 70% or so of the entire NFIP policy base. And it's about the same for us as well. But we are going to be expanding to additional states as we go throughout the year. So the quotes and applications are your return, with the prepaid envelope. It clearly indicates here's the private flood alternative policy number and a separate coupon that went with that mailing to the customer and the prepaid envelope to send back. They sign them, complete it, and send it back. So with this, I'll open it up to some questions, but I wanted you to know. Let me jump back just for a second. When it comes to the carriers, We have Western World. We have ACE, which some of you now know as Chubb, right, out of London. We have Channel Syndicate, and we have Hiscox Syndicate in London. So in some states, for example, in Texas, all four of those markets are available, and the NFIP. So literally in that circumstance, if you had a Texas risk, right? Remember, if you're sitting in North Carolina, you could indeed have a client that has a Texas risk. So you could, once you're duly authorized, you could solicit that customer for that particular step. You could look that customer in the eye or talk to them or email them and say, hey, look, not only did I go out and shop it, I shopped it against 5 marketplaces. And let's say, for example, Western World said no, ACE said no, Channel said no, Hiscox said no, and the only one was the NFIP. So what does that mean? Well, that means, again, that you tried to find a competitive market for that customer and for that particular risk, and given that risk location and the rating attached to it as far as the premium goes, the private marketplace said, no, thank you. But the NFIP is a good deal, even though we may not like the rates associated with it, and sometimes the confusion as it relates to the program itself. But, hey, folks, that's the best I could do for you. But the good news is I'm going to check it again next year as well.
You do have a lot of great questions in the question box. The first one is, are existing private flood alternative agents indicating that their clients are interested in a private flood policy not backed by the federal government, a surplus lines flood policy?
Yes, there are. And there's some that would, at the end of the day, are going to want to stay with the NFIP, and that's fine. We're not here to replace the NFIP. We're here to work that marketplace to provide your customers, all right, with the best product and pricing and coverage available to them. But here is some of the circumstances you'll find those customers that they went down the street or they went somewhere else, and it was over $25. So whether you're saving the customer, let's say $40, right, on a preferred risk type policy, or whether you're saving the customer hundreds or maybe even $1,000 or more, right, that customer deserves the opportunity to make that decision and to have their professional advisor present that to them. So yeah, we've had a very good take-up rate on it as we've gone across the country.
Okay. Here's another one. What are the differences between Wright's private flood and other private flood?
Well, first of all, everything is done online with our system. We don't go outside. You're not vendored out somewhere. It's not supplied somewhere else. All right, so the same people you've got today are the ones you would work with going forward. That's number one. Number two, we were the first to offer these additional enhancements. For example, the replacement cost on secondaries and rentals. All right, we were the first to offer the additional living expense or loss of rents. So we're going to continue to work on that, and we have other ideas that we're working with our partners on, an endless list of ideas that we presented with them. So
okay. If I allow permission to Wright Flood to send private flood renewal offers to my clients, is there something further I need to do to promote private flood?
I would always encourage you to reach out to your clients as you can. We have some postcards that effectively, or postcard layout that you could PDF, take that, print it, and send it to your customer to tell them in advance that they're going to get that. So you could do an agency letter. You could put it in the newsletter that many of you do quarterly or monthly. However, anytime you could acknowledge that to your customers is always the best way to do it.
Okay. Does your private flood policy require an elevation certificate to be rated? Do you accept properties in the high-risk flood zones?
Yes, we do accept risks in the high-risk zone. And it varies by slip and by location and what the aggregate limits that may or may not be available from each of the particular carriers. We do require an EC. Again, remember I told you we follow the same rules as the NFIP, so you would go through that process. I'm a little bit cautious, guys, because I know there's programs out there that say, gee, you don't need an EC, and the example I consistently use is, okay, let's think about this. You're going to write automobile insurance, right? And you have two risks. One is a 62-year-old married male driving a 40-year-old Chevrolet Malibu to and from work about 5 miles, 10 miles a day. And the second is a brand new 16-year-old single male who even though they had their license for 30 days, have effectively had 3 speeding tickets, 2 DWIs, and a pending bond hearing. Now, you're going to charge the same rate, or you're not going to use the driving record or the experience as a way to rate policy? So what is the driving characteristics for flood exposure? If it's not the elevation, if it's not the blockage of water based on an obstruction. So I have a genuine concern that in the long term that's viable. Okay, I'm not saying it's not. I'm just saying that at this point, until I get some further information, I just have to question it based on my 40 years in the insurance business.
Interesting. Okay, so the next one. What do I do if I want to quote a private flood alternative policy today?
Same thing you do right now as it relates to the NFIP policy. Right, you're going to sell through Wright. You go to the Wright system, start the right way, right? Go through that process. And again, as soon as you hit the coverage and deductible option, if you're in one of those states that are up and running now, that will automatically go out. If you've signed the producer agreement and got all that work done already, okay, it will go out there and it'll ping the system and it'll come back and tell you. If you don't get anything back other than the NFIP quote, guess what? Everybody said no. If it qualifies, you'll get it. So if it fits, you can.
Great. Are lenders accepting the PFA policy as meeting their lender requirements?
Yes. On occasion, we've had conversations where we've had initially a mortgage lender say no, and I'll say why. We had one the other day where they said, well, because it doesn't have the appropriate cancellation clause. Well, it does. It has the 45-day notice. It's required. And once we pointed that out, and off it went. But, for the most part, we have not.
And we also do have a handout that addresses that as well. Here's a really good question. What about concerns about losing the NFIP grandfathering credits or subsidies if my client needs to go back to the NFIP policy in the future?
Perfect. That's a great question. Let me address it in 2 different ways. First of all, let's talk about renewals. If that's a grandfather policy, okay, or newly mapped and is flagged in the system as such, for those renewals, we block the solicitation of that product, and we don't send out a solicitation for that. And why? Well, here's the reason. I don't think that it's a great decision either for the consumer to make a decision based off a piece of paper, right, that has the exposure to potentially losing grandfathering. Why? Well, currently the way the law sits, right, if they drop out of the program and they come back in, guess what? They come back in paying the full tilt, right? It's just like when people are newly mapped, if they don't take advantage, right, and they say, that's okay, I own my house for cash, and they go to try and sell it 5 years down the road, many times it becomes that Christmas heirloom. That's the one that, that my little kids made that little thing when they were 5 years old, and every year I get it out and I put it on the Christmas tree. That's what's going to happen to that house, because when they go to sell the house, suddenly it's going to be, oh, gee, you lost your grandfathering status, right? So now that to buy that house means I have to pay $1,600 or $2,500 a year for flood insurance, when the guy down the street, I can buy his house and maybe I don't have to buy a policy at all. Or I buy one that's already actually rated to actually save money. So it can be problematic. And I've had customers that have, for example, that bought off the internet. I went out there and I found this great deal on the internet, and they're looking at saving, $100, $500, $1,000, whatever it is. And they make that decision. We think that it's absolutely essential and important that you as that professional advisor, you as that professional sit there and say, well, listen, Mr. Sloan, let me explain to you. Yeah, you could save $600, but let me tell you what happens currently under the law if you have to come back to the NFIP. You lose that, it's going to cost you this. So while you may save money today, tomorrow it could make your house unsellable, right? Or it could cost you a lot of money coming back into the program. Now, if H.R. 2901 and the Teller-Hester bill work their way through the Senate and they come out and they pass a bill and they sign it into law, one of the provisions therein is that continuous coverage is continuous coverage, be it private or public, and then people will be able to basically move back and forth. If that passes and is signed, then that rule, and depending on what exactly the legislation says at the end of the day, that may no longer be a problem. But we don't think that's the right thing to do that customer in the mail. Now, if it's a new piece of business and you're quoting that customer, right? And you want to sit there and explain that differential to the customer and have them initial and sign and document everything, perfect. Go for it. But we're not going to do it through the mail.
Okay. We're talking about disclosures. Do the disclosures come along with the private flood policy, quote, are they state specific?
Yes, indeed. And as I said, each state has a little different slice of the apple, if you will, as to what's required. And again, if you've operated in the surplus lines environment at all in your particular state, it's going to be the same forms that are going to be required, whether it's a diligent effort form or whether it's a disclosure form or whether it's both. Okay, but they are state specific and they are provided.
Oh, good. What should I tell my clients if they're concerned about claims being paid by someone other than the federal government?
Well, first of all, again, those claims are going to be handled by the same people you've trusted for years and years and years and years to handle it. Every one of these carriers, again, that we talked about, and anyone we'd ever consider, has to meet the same financial category. And when you look, for example, at Western World, and you may or may not have heard of Western World in many of your marketplaces, but the company was around for 50 years. It's owned by a company called Valdis. This New York Stock Exchange symbol for that company is V as in Victor, R as in Roberts, about a $4 billion market cap company. The company is about 11 years old. Those are the types of companies that are financially secure, and they're not writing every risk. They're very selective in what they want to do and the aggregate exposures they want to have in any particular area.
Okay. Here's a good one. Is it easier to quote the PFA than to quote Wright Flood's NFIP product?
No, they're both easy. Right now, somebody's shaking their head out there, going, "Oh yeah, right." No, really, you go into the system. If you sell a policy and you want to quote risk, you start the same way, and you're gonna find out when you hit that coverage and deductible that you got the option, and you just go from there. And so you're going to complete it the same process. We've made it as simple and as easy as we possibly can.
Okay. Other than Western World, are there any others that offer enhanced coverage?
Yes. ACE, with their program on primary residences only, also provides $5,000 worth of additional living expense. However, that $5,000 allowance is within the coverage A limit. All right. Some folks may say, "Well, gee, that's what happens." Well, the average claim in Sandy, okay, where we paid, $1.5 billion or so, I think. The average claim there was $60,000 in New York and about $58,000 in New Jersey. The ACE policy will provide that ALE, but that's only on primary residence. Hickox and Channel are basically a me too of the NFIP with a premium savings and discount to the consumer. Okay.
You said you had a number of carriers involved. Can you tell us more about each one of them?
Okay. As I mentioned, it's going to vary a little bit by state, okay, as to the carriers that are in that marketplace. For example, for those of you in Florida, we have Western World, Hiscox, and ACE. In New Jersey, we have Western World Channel, ACE, and Hiscox. In Texas, we have, again, all four of those companies, plus the NFIP, obviously, in all these markets. In Louisiana, we have Western World and Hiscox. And in California, we have, again, all four of those, Western World, ACE, Channel, and Hiscox, available in each one of those marketplaces. Now, everybody likes has their own risk criteria, just like you have in your automobile, your property markets, commercial markets. Everybody has kind of the sweet spot they look for. Western World has a proprietary surge model that they developed. They have 11 PhDs, a meteorologist and hydrologist, and all these guys that have worked on developing their own proprietary system that they use as far as modeling and looking at a particular risk to accept or reject. ACE, for example, likes both primaries and secondaries. Channel really only wants pre-firm secondary residence. Why? Well, the rate's higher, or what they say in London, chunky, and it gives them that edge that they believe that they can compete effectively with the NFIP. Hiscox really is interested in the PRPs, both primary and secondaries on the PRPs. They all have that particular sweet spot, that particular flavor of ice cream they want, and our job is to make sure when that risk comes in through the right system, through what you've done on the outside, that we slot that to the right one with the best coverage available for your client.
Okay, great. Are you ready to conclude, Mike?
I am, and I want to thank each of you very, very much, and again, tell you how much we appreciate the opportunity to work with and be of service to you and to your clients, and for the opportunity to discuss the private flood alternative. And again, if you have any questions, please feel free to direct them to myself or your regional sales manager.
And on behalf of Mike Sloan and myself, have a great day. Thank you.
Bye-bye.